Hi friends, welcome to the channel JIV and CIV Made Simple. So this is our unit number 28 theory portion and we are going to discuss asset classification and provisioning norm. So before going into the chapter, let's see what are the topic which we have to cover in this particular chapter. So we can see there are four topic. First of all, we will see the objectives of it, an introduction, we will go through the asset classification and finally provisioning norms. So although it look quite simple, but it is voluminous chapter. Almost in BFM book you will see it is covered in almost 40 pages. So we will try to cover each and every portion. So let's start with the first introduction part. So have you ever wondered how bank make money? Right. So you know that their biggest income source is the interest, right? The biggest income source for bank is what we call as interest. And that is called interest income, right? So what is the meaning of interest income? When we talk about interest income, it means that the extra amount they charge when they lend money, right? Interest means the extra amount they charge when they lend money. But here is the catch. What happen if the borrower stop paying, right? What will happen if the borrower stop paying? Does the bank still count it as income? Let's break it down in the simplest way possible. Imagine you lend money to a friend and agree that they will pay you back with some extra amount as interest. That is exactly what bank do on a much bigger scale, right? What bank do? Bank charge interest on a loan or advance, right? And record this interest as income. So this interest is charged and then this interest is recorded as income, right? So expecting the borrower to pay it back. Now there is a system which we call as accrual basis. This is accrual system. So at first bank assume that everything is fine, so they book the interest as income. So they assume that everything is fine, so they book the interest as income even before actually receiving the cash. They have not received the cash, but they have booked the interest as income. And this is called accrual basis of accounting. So income is recorded when it is earned, not necessarily when it is received, right? So income is recorded when it is earned, that is the accrual basis of system. Now what if the borrower stop paying? What will happen if the borrower stop paying? Now here is where it gets tricky. If the borrower does not pay the interest for 90 days, you can see if the interest is not recovered within 90 days, that means borrower does not pay the interest for 90 days, the bank can't keep pretending it's income anymore. So if the borrower does not pay the interest for 90 days, the bank can't keep pretending that it's income anymore. It's like if your friend promised to return your money but keep delaying. At some point you realize that this is not guaranteed money anymore, right? So when this happen, the loan turns into NPA, right? The loan become non-performing. So when interest is not recovered within 90 days, the loan become NPA, that is non-performing asset, and the bank then stop recognizing interest as income, right? So what happened earlier, the bank recognized interest as income, but once it realized that the asset is turning non-performing, so bank do not realize bank do not recognize that asset as income because there is no guarantee it will be recovered. Instead of assuming it will be paid, the bank start treating it cautiously. So what we learned from this particular slide, the first thing is that bank earn mainly from interest on loan. Second thing is that initially they count interest as income even before receiving it. Third thing is that but if a loan remain unpaid for 90 days, it become NPA, that is non-performing asset, and the bank stop recording interest as income once a loan turned into NPA. So this rule help bank stay financially healthy and not overestimate their earning. Sounds simple, right? But this small rule has a huge impact on banking operation. So stay with me as we break down how bank classify their asset. Let's see. So that is we have discussed the accrual system of accounting just now. Now let's discuss the next point that we have, classification of asset into four main categories and subgroup. So this is what we are going to discuss now, that is called asset classification. So did you know that before 1991 bank in India had different way of reporting their income and bad loan? So this was 1991. Before 1991 there was different rule. After 1991 there is different rule. You know, some banks showed profit on paper even when borrower were not paying back. But then a game changing reform came in which was led by M. Narasimhan. Right. So this game changing plan was led by M. Narasimhan. Right. So what it did do and why does it matter for your BFM examination? Let's break it down. So you know, back in August 1991, the Indian banking system was facing a big issue. What was the issue? The bad loan were piling up, right? The issue was that bad loan were piling up. right? And the bank were not following a uniform method to classify them. Bad loan were piling up, no uniform method was being followed to classify them. So to fix this, a high level committee led by M Narasimhan was appointed to review the financial system. What was the goal? The committee wanted bank to have a clear and transparent balance sheet that follow international accounting standard, right? You can see clearly that clear and transparent balance sheet that follow international accounting standard, right? So this committee was appointed. Now this means that no more showing fake profit by recording interest that might never be received. So no more showing fake profit. A uniform system to classify the bad loan, and proper rule on how much money banks should keep aside, that is provision for potential loss. Three goals were there. The first goal was no more showing fake profit. Earlier what bank used to do, that they used to show the fake profit. Now no more fake profit. Second thing is that uniform system to classify the bad loans. Third thing is that proper rule on how much money banks should keep aside. So basically what changed? The next pertinent question is, after this Narasimhan reform, what changed? So earlier bank counted interest as income even if the borrower was not paying. But the new rule say, what does the new rule say? That if a loan is NPA, that is non-performing asset, right? The rule says that if a loan is an NPA, that is non-performing asset, income should be counted only when it is actually received, right? So this should not be done on, this should based on actual recovery, not on accrual basis. So this is the key point. After 1991, after the Narasimhan committee reform, what changed? That earlier bank counted interest as income even if the borrower was not paying. But the new rules say that if a loan is non-performing asset, income should be counted only when it is actually received, right? So asset classification should follow clear and objective criteria. You can see clearly written here, the asset classification is based on clear and objective criteria, right? No guesswork is involved. So RBI introduced something called prudential norms. So here you can see the keyword written, prudential norms. So this prudential norms was introduced by RBI, ensuring that all banks follow the same system for income recognition, asset classification and provisioning, right? So this prudential norms was introduced by RBI. So question may be asked that who introduced this prudential norm? Answer is RBI. For what it was introduced? For income recognition, asset classification and provisioning. So what we learned from this slide? We learned that the Narasimhan Committee 1991 changed how bank classify loan and report income. Bank could no longer show fake profit, and prudential norm by RBI make reporting transparent and uniform across all banks. So the focus shifted from assumed profit to actual recovery, right? So basically this reform changed the way Indian bank operate. But how do exactly bank classify asset? Let's discuss now. So now you know that what were the changes brought by the Narasimhan Committee reform in 1991. Now let's see some important definition here. You can see the first definition we have. So ever wondered what happened when a borrower stops paying bank a loan? Does the bank just wait and hope, or do they take action? In banking terms, a loan that stops generating income is called non-performing asset, right? But what exactly does that mean? And what does a loan, and when does a loan turns into NPA? Let's break it down in the simplest way possible. Imagine you lend money to a friend and they promise to pay back in monthly installment. So your friend promised to pay back in monthly installment, right? But at first they pay regularly, but then one month they miss a payment. You remind them, but still no money comes in for 3 months straight. That is when you realize that this loan is in trouble. Bank face the same issue, but on a much larger scale. So when does a loan officially become an NPA? So a loan turns into NPA if the borrower does not pay interest or installment, right? If the borrower does not pay interest or the principal for 90 days, right? For a regular term loan. So suppose it is a regular term loan, if the borrower does not pay for 90 days for 3 months, right, it will turn into NPA. Second thing is that suppose you have given overdraft or CC, that is cash credit, right? So suppose an overdraft which stay out of order. What is the meaning of out of order? This word means out of order means that there is no proper credit activity, no credit activity in this particular CC account or overdraft account, right? So that in that case also this CC account will turn NPA. The third case is for the bill overdue, right? So before bill, you know, a bill remain unpaid for our 90 days. Suppose there is a bill which remain unpaid, which is overdue. When I say overdue, it simply means unpaid. A bill which remain unpaid for 90 days, right? For our 90 days. So what is the meaning of bill here? You know, there are two type of bill: bill purchase and bill discounted, right? When bank purchase bill, when bank discount bill. So for the case of bill which remain unpaid for more than 90 day, it turns into NPA. The fourth case is that for farm loan, right? Suppose it is a farm loan, right? If we talk about the farm loan, the rule is different depending on whether the crop is short duration or long duration. If it is a short duration crop, repayment should not be overdue for more than 2 crop season. You can see clearly written 2 crop season, right? If it is a short duration crop, repayment should not be overdue for more than 2 crop season, and if it is a long duration crop, the repayment should not be overdue for more than 1 crop season. So this is the rule you have to remember, right? So we have talked about CC, bill, and also term loan. What are the conditions for these loans to become NPA? Now let's talk about something else, that is securitization transaction. We know about this securitization transaction. So in the case of securitization transaction, when a loan turns into NPA, let's discuss now. So even in securitization transaction, if the liquidity remain outstanding for 90 day, like liquidity facility outstanding for more than 90 day, it will become NPA. And suppose it is a derivative transaction. In derivative transaction, overdue amount that remain unpaid for 90 day can turn into NPA, right? So one more rule is there: if a bank charge interest in any quarter and the borrower does not pay it fully within 90 day, the account will also classify it as NPA. So you can see that you can classify an account as NPA if the interest charged during any quarter is not serviced fully within 90 day from the end of the quarter, right? So these are the condition for which loan become NPA. So what we have learned till now, that NPA is a loan that stops generating income for the bank. The 90-day rule is crucial. Most loan turns into NPA if the payment are overdue for more than 90 days. A special rule apply for farm loan, derivative transaction, and securitization deal, right? For farm loan, you know, depending on whether it is a short duration crop or long duration crop, you know it very well, right? For derivative transaction, we have just seen that for derivative transaction, overdue amount that remain unpaid for 90 days also turns into NPA, right? So now you know exactly when a loan turns into NPA. But what happened next? What does the bank do once an account is classified as NPA? Stay tuned, because in the next part we will talk about how NPA are classified into different category and why it mattered for your BFM examination. Let's talk about it now. So friends, let's first start with what happened when a borrower has overdraft or cash credit account but stop making the payment. Borrower has an overdraft, OD account, you must know it. You know it very well, right? OD account, CC account. Borrower has this kind of account but it stop making payment. Does the bank still consider it normal? Not at all. The account is classified as out of order, right? So it becomes out of order status. This is the keyword you must remember. It is a red flag. It is a kind of red flag in banking. But what exactly does that mean, and why is it important for your BFM examination? So imagine you have a credit card with a limit of 1 lakh. Let me give you an example. You have a credit card with a limit of 1 lakh, okay? And if you keep using it beyond the limit and don't repay the due, you are in trouble. So you have exceeded the limit. You have used entire 1 lakh limit, right? And beyond the limit, suppose you look 1.2 lakh, you use 1.2 lakh and you do not repay the dues, you are in trouble. Similarly, in banking, an overdraft or cash credit is considered out of order if the first condition is that outstanding balance continuously exceed the sanction limit or drawing power, or even if the balance is within the sanction limit, account can still be called under out of order if there are no deposit for at least last 90 days as on balance sheet date, right? And the credit are not enough to cover the interest charged for those 90 days. So two way, right? Let me remind you, there are two conditions. The first condition is that outstanding limit, so limit is 1 lakh and you have outstanding balance 1.2 lakh. So in that particular case, account will call out of order. And even if suppose limit is 1 lakh, right? Suppose limit is 1 lakh, you have been provided limit of 1 lakh and your outstanding balance is 80,000 only. Even if this is the case, but you have not no credit for last 90 days, you have not credited the account for last 90 days, it will still be classified under out of order status. And the second condition is that if the interest charged for that period, credit is not sufficient to cover the interest debited during the same period, right? Then also the account will be called out of order. So remember, these are the special rule for CC account, right? Cash credit account. Now second thing is that this means account is practically inactive or is struggling and the bank sees at a warning sign. Now what is overdue? What is the meaning of this term overdue? You must know this term, out of order and overdue. So apart from out of order, another important term is overdue. Any amount due under a loan, overdraft, or any credit facility that is not paid on due date, it is called overdue. For example, if you take a car loan and miss an EMI, so the unpaid EMI is overdue. You miss an EMI. Suppose EMI was deducted on 10th of the month and you did not pay. So unpaid EMI, right, is called overdue. Is it clear? Right. Or suppose if a company take a business loan and falls and fails to pay an installment on time, so it is called overdue. It's quite simple, right? So this is what we learned regarding what is the meaning of overdue and what is the meaning of two things we have just learned, overdue as well as we have learned the out of order, these two terms, right? So now let's talk about income recognition. So let's discuss what is the meaning of income recognition. So friends, income recognition means when can bank count interest as income, right? So the question is, when can bank count interest as income, right? So you know that bank make money by charging interest on loan, but what if the loan turns into NPA? Can the bank still count the interest as income? The answer is no, right? The loan become NPA, right, and the bank cannot count the interest as income. But here is the golden rule: bank can recognize income only when they actually receive it. So income recognition should be objective and based on actual recovery. That is what I am telling. I am again repeating that golden rule is that banks should recognize income only when they receive it, right? Once they receive the income, once they receive the interest, then only they should count it as income. Is it clear? Right. So here is the golden rule: bank can recognize income only when they actually receive it, not just when it is due on paper. Okay. Now the second thing is that for performing loan, suppose we have a performing loan, the bank record interest as income on accrual basis. Remember it, right? If we have a performing loan, then on accrual basis the interest is recorded, right? But for NPA, bank must follow a cash basis, right? So for that performing loan accrual basis and NPA, it is cash basis. This is the differentiation, right? So they should, for NPA, bank must follow a cash basis, means they can only count interest as income when the borrower actually pays it. However, there are some exceptions where bank can recognize interest as income on the due date. What are the exceptions? Let's see. Right, just like you can see, if the loan is backed by FD, NSC, IVP, KVP, or life insurance policy, right? So and there is enough margin, and suppose there is enough margin, adequate margin is available. So in that case, bank can count the interest as income, right? So just now what we have seen, so we have two kind of asset. For performing asset, accrual system is used. For non-performing asset, cash based system is used. And suppose there is some kind of advance, if the loan is backed by fixed deposit, NSC, IVP, KVP, life insurance policy, and there is enough margin, so the bank can count interest as an income. Okay, that is the point. Now there is something called renegotiation fee. So the next point you can see clearly written here, that it is written renegotiation fee. What is the meaning of this renegotiation fee? Let's discuss it now. You can see sometimes bank reschedule or renegotiate loan for a struggling borrower. So for suppose some borrower is struggling, right? Some borrower is struggling. For these struggling borrower, what bank do? So bank can reschedule, bank can renegotiate loan. Any fee, any commission earned from this must be spread out over the entire period of the renegotiated loan, not recognized immediately. Right? What happened? Sometimes bank reschedule or renegotiate loan. So borrower is struggling, he is not able to give you money, right? Pay the EMI. So what bank do? Bank reschedule it or bank renegotiate the loan. So any fee, any commission earned from this must be spread out over the entire period of the renegotiated loan, not recognized immediately. That is the key point. You must remember it. That is obviously bank. If bank will renegotiate, it will charge commission on it. It will charge fees on it, and whatever fee it charge, it should be spread over the entire time period of the loan. It's not that they should recognize it immediately. Is it clear now? So what we learned, the key takeaway is that whatever we learned till now is that out of order, right? We have talked about the out of order. So out of order, that is OD and CC account. We talked about the OD and CC account. So it is in trouble if it crosses the limit or has no proper credit for 90 days, right? Clearly remember it. Now overdue, we talked about the overdue. So overdue means any unpaid amount past the due date is called overdue amount. And then we talk about the income recognition rule, that interest on NPA should be counted as income only when received, except for secured advance with enough margin, right? So now you understand why bank closely monitor account and why income recognition is a big deal. But what happens when an NPA stays in default for a long time? How do banks classify them? Stay tuned, because in the next part we will break down the categories of NPA and why they matter for banking regulation. I hope this make your concept clear, right? So here you can see the key points on income recognition and NPA management. So let's start with this. I think this is repeated part, no need to repeat it. Okay, so from here we will start, that is government guaranteed advance. So have you ever wondered how bank treat loan guaranteed by the government when they turn bad, or what happened to fees and commission when a loan become an NPA? These are critical concept for BFM examination, and today we will break down in the simplest way possible. So stay with me till the end and you will be able to understand it. The first thing is that government guaranteed advance, are they special? Are these government guaranteed advance special? Normally when a loan become NPA, bank stop recognizing interest as income unless it is actually received. Already I told you that for NPA, for loan that turned NPA, cash based system is used, that bank do not recognize income bank do not recognize income unless it is received, right? But what about the loan backed by government guarantee? You must know, you might think, oh, since the government is guaranteeing it, the bank can still count the interest as income, right? Wrong. Even for government guaranteed loan, bank cannot record interest as income unless it is actually received. So you should know it, right? So interest or income should not be taken on income unless realized. For no matter it is for government guaranteed loan or for normal loan, you must remember it, right? So you must know that if the interest was previously recorded as income but remain unpaid at the end of the year, it must be reversed. This rule apply even if the loan is government backed. Understood? That the reversal of interest accrual in the prior year is not realized at the year close. Right? It is applicable to government guaranteed account as well. So earlier you recognize an interest as an income, but you do not receive the payment, even if it is backed by the government guarantee. So you have to that means I mean what I'm telling you, if the interest was previously recorded as income but remain unpaid at the end of year, interest has not been paid at the end of year, so it must be reversed, right? So means earlier if you have done in accrual basis, you must convert into cash basis, right? That is called reversal. This rule apply even if the loan is government backed. Is it clear now? Now let's talk about the fees and commission. The fees and commission, let's talk about it now. Regarding the fees and commission, just zoom it out. Yeah, so you can see that what happened when a loan go bad, right? So we have a loan that then that loan turns into bad, right? What happened to fees and commission? So bank don't just earn from interest, they also charge fees, commission and other service charge. But what if a loan turns into NPA? The golden rule is that as long as loan become NPA, the bank stop recording any more fees or commission as income. So if there are uncollected fee or uncollected commission, right? So if there are uncollected fees or commission, so they must be either reversed. So they can either be reversed. Reverse means removed from the income book, or they can be provided for. Provided for means set aside as loss reserve, right? So these two things has to be done. So what we have talked about, that obviously bank do not provide any service for free. There is fees, commissions that they charge, obviously, right? But if there are uncollected fees, if the fees are uncollected or commissions are uncollected, that must either be reversed, means removed from the income book, or they can be provided for, that is set aside as loss reserve. Now let's talk about the lease asset. So let's talk about what is the meaning of lease asset now. You know, banks sometimes lease assets like machinery, vehicles or equipments to customer, and they earn something called finance charge. So here you can see the keyword written here, finance charge. So what happened, that banks sometimes lease asset like machinery, vehicle and equipment to customer, and they earn finance charge similar to interest from these leases. But what if the lease payment stop coming? The rule is that if finance charge was previously counted as income but remain unrealized, the bank either must reverse it. So whenever I say reverse it, it means that it is removed from the income book. So bank may either reverse it or provide for it. So provide for it means it should be from loss reserve. It should form the form of loss reserve, right? So these two things you must remember, so that if there was a financial charge which remain unrealized, it should either be reversed, you can see clearly written here, or it should be provided for, means it should be from the loss reserve, it should be counted as a loss reserve, right, in the current period. This ensures that bank do not show fake income in their book. That is the main point. Now let's talk about recovery in NPA. If we talk about the recovery in NPA, so where does the money go? Let's say a borrower start repaying their loan, NPA loan. Can the bank immediately record it as income? Yes, but with one condition. Condition is that the repayment must be from the borrower's own fund, not from a new loan given by the bank, right? So suppose a borrower, what is happening, let's say a borrower start repaying their, so loan was NPA, borrower start repaying. So question is, will the bank immediately record it as income? Yes, it can record it as income, provided this fund is not from the new loan given by the bank, right? If there is no clear agreement on how to use the recovered amount, bank must follow a uniform accounting principle. If there is nothing clear agreement on how to use this recovered amount, so bank must follow a uniform accounting principle to ensure fairness and consistency. So what is the key takeaway from the learning we have done till now is that bank cannot record interest on NPA as income unless actually received, even for government guaranteed loan, right? So interest on NPA as income cannot be recorded unless actually it is received. Second point is that unrealized fee, unrealized commission on NPA must be reversed or provided for. Third point is that if a lease asset's finance charge is unpaid, it must be reversed or it must be provided for. Fourth point is that recovered amount from NPA should not come from fresh loan, otherwise it is just recycling bad debt, right? So recovered amount from NPA should not come from fresh loan, right? That is the point. So understanding these rules ensure that bank don't overstate their income and maintain transparency in financing. Now what do you think will happen to a loan when it remain unpaid for even longer period? In the upcoming slide we will uncover NPA classification, provisioning norms, and how bank tackle long-term defaulter. So let's talk about it now. Asset classification and categorization of NPA. This is the next topic. Have you ever wondered how bank decide whether a bad loan is just struggling or completely unrecoverable? Is it just struggling or completely unrecoverable? The classification of NPA is crucial in banking. So stick around as we simplify substandard, doubtful, and loss asset in a way that you will never forget, right? So now let's talk about understanding the NPA category. There are the three stages of trouble. So the main point we are discussing is the three stages of trouble. So the first stage is what we call as substandard asset. You can see clearly written here. A loan this is the first warning signal. The substandard asset is the first warning signal. So a loan is classified as substandard asset when it has remained as NPA for up to 12 months. Clearly written. If the loan has remained NPA for 12 months, it will be classified as substandard asset. But what does that mean? It means that borrower is struggling and there are clear signs of credit weakness, right? That particular borrower is struggling and credit weakness sign is there, right? The bank might not recover the full amount as the security or collateral is not enough, right? So when I say talk about substandard asset, it means it has remained NPA for 12 months. Right, it clearly means that borrower is struggling and there are clear signs of credit weakness. The bank might not recover the full amount as security collateral is not enough, and it also means that if the borrower does not improve, the bank might face a loss. So credit weakness, not recover the full amount, and the bank might face a loss. So that is what it means when a loan is classified as substandard asset. Think of it like a car with engine trouble. It is still run, but if not fixed, it might break down completely. That is what it is, a substandard asset. So condition you should remember, NPA for less than or equal to 12 months. Now let's talk about the doubtful asset. If a loan remain in the substandard asset for more than 12 months, so it is in the substandard asset from 12 months, right, till more than 12 months, right, but with ever lower chance of full recovery. So then it becomes the doubtful asset. So at this stage what happened? If we talk about the doubtful asset, what happened? That the loan has all the weakness of substandard asset. Whatever weakness, whatever characteristics are there in the substandard asset are present in doubtful asset, right? But lower chance of full recovery. Here what has happened? Here is the lower chance. The full recovery chance is quite low, right? The uncertainty is high and the bank is in risky position, because in the doubtful asset uncertainty is quite high and bank is in a position which is quite risky. Imagine a building with severe crack. It hasn't collapsed yet, but it might at any time, right? So that is what we call a doubtful asset. So we come to know what is substandard, what is doubtful. Now let's talk about the loss asset. What is the meaning of this term so called loss asset? Let's discuss it now. That this is the last stage. This is the worst case scenario. A loss asset is a loan that the bank, its auditor or RBI has officially identified as complete loss. So this is the last stage. I told you 3-stage process. The first stage was substandard, second stage is doubtful, and the third stage is loss. when the RBI auditors or bank has recognized, officially identified it as complete loss. And this loan is uncollectible, and there might be some salvage value, or recovery value, but most of it is gone. Even if it is still in the book, it must be written off ASAP. So it must be written off. Now it is not completely written off till now, but it must be written off as soon as possible, right? Think of it like a burnt house. There might be few items to recover, but the structure is gone. So that is what we have discussed, the 3 stages, right? So first is substandard, doubtful and loss. Now let's talk about account with temporary deficiency. So this is the point which we are going to cover now. So why not to call it an NPA? So suppose there is an account with temporary deficiency. So why not to call such an account as NPA? So not all financial issues mean a loan is an NPA. Some problem are just temporary hiccups. Like, let me give you example to make it more clear. Like suppose a business exceeding its drawing power. There is a drawing power of business, right? So there is a drawing power. Just you can see inadequate, like issue like inadequate drawing power. So business is exceeding its drawing power, right? Drawing power just means loan limit. Whatever loan limit is there is called drawing power, and the business is exceeding its loan limit. So it is just a temporary deficiency, or a business late submission of a stock statement, right? A stock statement has been submitted late, or a loan has not been renewed for reviewed on time, or non-renewal of limits has not been renewed on time. So if these deficiencies are there, like drawing power exceeding, or non-submission of a stock statement, or late submission of a stock statement, or non-renewal of limit, so these are the sign that these are the issue. That does not mean that the loan is NPA. These are temporary deficiency, temporary hiccups. So what is the golden rule? The golden rule is that if there are temporary issue, the loan should not be classified as NPA. Only actual non-recovery matter, right? That matters. So that is the point. That is what we have to know. Now the next question is, when does a working capital loan become an NPA? Very nice question. Like, very nice question. Let's try to answer this question. So suppose we have a working capital loan. You are familiar with this working capital. When it will become NPA? What are the conditions under which working capital loan will become NPA? Even if a business is running fine, a working capital loan can become an NPA if the conditions are following. If there are irregular drawing, this is the first condition. If there are irregular drawing for 90 days, right? If there are irregular drawing for 90 days, then it will become NPA. Second condition, if the loan's credit limit are not reviewed or regularized within 3 months from the due date. So this is the condition, 3 months from the due date. So the first condition is that if there is irregular drawing and it persists for 90 days, then what will happen? Working capital loan will turn NPA. Second condition is that if the loan credit limit are not reviewed or regularized within 3 months from the due date. And the third condition is that if the renewal is delayed beyond 6 months, it is treated as NPA, right? Let me show you. If the renewal of limit is delayed beyond 6 months, right, it is treated as NPA even if the renewal is in process. So remember what are the conditions. I am again telling you, the first condition is that working capital loan will become NPA. The 3 conditions are to be met. Either of the 3 conditions. The first condition is that account has irregular drawing for 90 days. Second condition is that loan credit limit are not reviewed or regularized within 3 months from the due date. So after due date for 3 months, loan condition has not been reviewed, has not been regularized, right? That is called credit limit review, irregular drawing. So again it is 3 months also, And renewal or review delay means what? If the renewal is delayed beyond 6 months. So here it is 6 months. If you have not renewed the loan for 6 months, it is treated as NPA. So what we learned till now, that bank must regularly check if the borrower is financially stable and follow the loan condition. So we have seen how loan move from substandard to doubtful to loss asset, and banks should not rush to classify an account as NPA. So here is a quick recap for your examination. First thing we learned is that for substandard asset, NPA for less than 12 months. We just talked now, substandard asset for NPA should be less than equal to 12 months, right? Which is a sign of weakness, partial recovery possible. Then we talk about the doubtful. Doubtful means what? Doubtful means substandard for more than 12 months. For more than 12 months, not equal to for more than 12. This is called doubtful. And then we talked about loss. Loss asset means identified by the bank or RBI as unrecoverable. It must be written off, right? Then we talk about some temporary issue. There are some temporary issue. A temporary issue is not equal to NPA. right, unless irregularity persists beyond the allotted period. Just now we have seen, suppose you are not renewing the loan, you have a working capital and you're not renewing it for the 6 month, obviously it will go into NPA. The credit limit has not been reviewed for the last 3 months, obviously it will go to NPA. And if they are irregular drawing for the 90 days, obviously it will go into NPA, right? So it is not like that if there are temporary deficiency you should immediately classify it as NPA. No, temporary deficiency is there, like suppose drawing limit has exceeded, like suppose a stock statement has not been submitted, like suppose credit limits has not been renewed. So on temporarily basis these are deficiency, but this can be cope up with. But if this deficiency continue for a longer period, then we have to classify it as NPA. I hope this make your concept clear. Now one question for you, if an NPA remain doubtful for too long, what happened next? Right, please write in the comment section what you think will happen if an NPA remain doubtful for too long. Now let's talk about upgradation of loan account classified as NPA. Let's talk about this point now. So what it means when I say upgradation of loan account classified as NPA? Ever wondered how a loan that was once classified as NPA can regain a standard status? So a loan was there which was once an NPA, how can it regain the standard status? So let's discuss it now. We are going to discuss it. So it is not just about repaying the dues. There are specific conditions bank must follow before upgrading an account. So what we are discussing is upgradation. So earlier the loan was NPA, now it become a standard. How we should upgrade the account? That is what we are going to discuss. And it is very crucial for your BFM examination. You know, just like a student who failed an exam can clear it by passing the retest, a loan classified as NPA can also become a standard again, but only if certain conditions are met. What are the conditions? Let's see. So for most of the loan, let me talk about the general for most loan, right? For most loan, if the borrower clear all overdue interest and payment, if arrear of interest, all overdue, whatever overdue interest and payment has been cleared by the borrower, the account is reclassified as a standard. Understood? Right, this is for most of the loan. But for restructured loan, we know we have talked about restructuring earlier, which have been restructured due to weakness, due to some deficiency, or due to some kamjori, right, due to some weakness on the part of the account holder, right, he is unable to pay, so the account has been restructured earlier, right? For restructured account which is modified, we have, when I talk about restructuring, what it means, we have modified the repayment terms. We have just modified the repayment terms. That is what I mean when I say account is restructured. So for restructured loan, different special rule apply which bank must follow carefully. For most of the loan, if the borrower has paid the unpaid interest and principal, then it can immediately be classified as a standard. But for those loans which have been restructured, so there is different criteria. So what is the learning? The learning is that just paying back the due amount does not always mean an instant upgrade. It depends on the loan type. Now let's talk about the upgradation rule for MSME loan. So if we have an MSME loan, what are the rule for upgradation? Let's discuss it now. You know, for MSME borrower, the upgradation process additional condition that the loan can only be upgraded after a specified period. Here you can see the loan can be upgraded after a specified period. What is the specified period? You know, which is 1 year from the first payment of either interest or principal. 1 year from the commencement of first payment of interest or principal. Loan was NPA, the borrower start paying, so the first payment when it was received, either interest payment or principal payment, from that day first year, after first year, right, that is whichever is later, either he had paid interest or he had paid principal, whichever is later, right, 1 year from that. And this is based on the loan with longest moratorium period in the restructuring loan. You know, there are some moratorium period which is given by the bank, right? So it is based on those loans with the longest moratorium period. Understood? So these are rule for MSME account with lender aggregate exposure less than 25 crore. So account can be upgraded to a standard account, but it must demonstrate satisfactory performance during the standard period, during a specified period. And what is the specified period? 1 year from the first payment of principal or interest, right? This is the condition. Now second point is that for MSME loan we are talking about a satisfactory performance. You know that to qualify for an upgrade, the borrower must ensure that no payment, that is no interest or principal, is overdue for more than 30 days. So this is called satisfactory performance. So nothing should be overdue for more than 30 days. This has to be ensured by the bank, right? Then only that particular NPA account can be upgraded to the standard account. Think of it like a probation period. The borrower must prove that they can maintain regular payment for a year before getting the standard status back. Now, that was for MSME loan. What about the cash credit and overdraft account? How to upgrade its status from NPA to standard? Let's see. So overdraft and cash credit account work differently. For these, upgradation happen only if the borrower ensure that the outstanding balance never exceed the sanction limit. So this outstanding balance, it should never exceed the limits, or we can say drawing power. DP you call it, limits you call it, everything means the same. Sanction limit or drawing power, whichever is lower. Outstanding balance should never exceed the limit or drawing power, whichever is lower, for more than 30 days. Right, it should not exceed the sanction limit or drawing power for more than 30 days. Imagine it like a weight loss challenge. If someone stay within their goal weight for 30 days straight, they pass the test. But if they exceed it, they must restart the countdown. Understood? So this is what is happen. This is how we classify, we upgrade the status of a cash credit and overdraft loan. We can only upgrade the status of cash credit and overdraft loan. The condition is that outstanding balance should not exceed the limits or the drawing power for more than 30 days. I think it is clear. So finally, revise what we have learned just now. We have revised that NPA can be upgraded if the first condition we have seen, that the overdue interest and principal, right, it are cleared. If overdue interest and principal are cleared, it can be upgraded. Second condition we have seen that for those MSME which exposure less than 25 crore, it shows satisfactory performance for a year. And third condition we have seen that the CC account or OD account, it maintain their limit, it is within their limit for 30 days. So these are the three conditions, right? For overdue loan, again I am repeating, so all overdue interest and principal are cleared. MSME which less than, for this is for most of the loan. If overdue interest and payment overdue interest and principal are cleared, then yes, we can upgrade it. But for MSME loan which exposure less than 25 crore, it must show the satisfactory performance. And what is the meaning of satisfactory, and what is the specified period we have just talked about now? And what about CC and OD account? Cash credit and overdraft account maintain their limit for 30 days straight. Now question for you, what happen if the borrower default again after the upgrade? Suppose we have upgraded the account as a standard and the borrower again default. So we will discuss it in our upcoming slides, right? So this is what we are going to discuss now. I hope this is quite interesting chapter. If you understand it, you can easily answer any question based on it. Let's see the next point. So friends, can a loan that has been classified as NPA really come back to life? Absolutely, but only if it proves that it changes its way. Let's break down how a loan can be upgraded from NPA back to a standard status, and the key condition is must meet. Just like a student who failed last semester can get back on track by performing well, similarly an NPA can be upgraded to a standard, but only after satisfactory performance, right? So what is the satisfactory performance? So first of all, let's talk about a standard account. Just wait a minute. Yeah. So a standard account, that a standard account that were downgraded to NPA or loan that were restructured will be considered for upgradation after they show positive behavior. So here is the key point. They will show after they show the positive behavior, right? In the repaying due. Simple words, we can say that the account must prove that it is stable and not a temporary success. It needs consistent performance. Now there is something called monitoring period. This is very important. How long does the bank need to monitor this performance before deciding on an upgrade? So the monitoring period starts once the resolution plan is put into practice. Here the condition is RP. RP means resolution plan. Once the resolution plan is put into practice, the monitoring period starts. Here is the timeline. The bank keep track from the resolution plan implementation until 10% of the outstanding debt is paid off. So starting from where, suppose the resolution plan starts from here, bank keep tracks of the loan, right, from when the resolution plan was implemented until outstanding limit 10. Suppose the outstanding limit was 1 crore, and till the point that, what is 10% of 1 crore? 10 lakh. Till the point that 10 lakh has been paid off, right? Until 10% of the outstanding debt is paid off. But wait, it does not end there. A minimum of 1 year must pass from the first payment of either interest or principal before considering an upgrade. So that is the minimum duration, right? So what I'm saying you, that monitoring period start from the resolution period implementation till the 10% of this outstanding loan has been paid off. So out for 100 crore, suppose 10 lakh has been paid off, right? But it does not end there. It must be minimum duration is 1 year, right? 1 year satisfactory performance, it should be reviewed. That means a minimum of 1 year must pass. Minimum 1 year, more than 1 year possible, but minimum 1 year. Right, a minimum of 1 year must pass from the first payment of either principal or interest, then it will consider as upgrade. You can see clearly written, before 1 year you can't upgrade it, right? 1 year from when? 1 year from the commencement of first principal or interest or principal. Think of it like a probation period. The loan has to show it is reliable for at least a year before being given a second chance. I hope this make your concept clear. Now let's talk about the regularization before balance sheet date. Regularize account near balance sheet date. Let's talk about this term, so-called regularization, which simply means fixing an account that is almost on the edge of becoming NPA. So suppose there is an account that is almost on the edge of becoming NPA. So question is how to fix it. That if an account only has a few credit recorded before the balance sheet date, bank need to be careful, right? If an account has few credit recorded, you can see clearly written here, if the account has few credit recorded before the balance sheet date, bank need to be very careful. Why bank need to be very careful in such case? Because there is a chance that this could look subjective. So you can see there is a chance to avoid this subjectivity. What is the meaning of subjectivity? It means that bank may be too lenient when considering if the account should be upgraded. So what I am telling you, that if an account has only few credit before the balance sheet date, the bank need to be careful, because there is a chance that it could be subjective. Means the bank may be too lenient when considering if the account should be upgraded. What we learn from that? Don't rush the upgrade. Bank need clear proof that the account is performing well, not just a few payment here and there, right? So that is the point. Now the next point is regarding the inherent weakness. What is the meaning of inherent weakness? Let's talk about it. So inherent weakness means even if an account seems to be improving, there is a catch. If the account shows sign of inherent weakness, meaning it is still not performing well enough according to the available data, it should remain in the NPA category. So that is called inherent weakness. Again I am repeating, suppose even if the account seems to be improving, there is a catch. If the account shows sign of inherent weakness, so if there is some inherent weakness in the account, meaning it is still not performing well enough according to the available data, so it will remain in the NPA category. So what does this mean? It means if there is any sign that the borrower is struggling despite a few payment, the bank has to be realistic and keep the account as NPA. So if there is any sign that the borrower is struggling despite few payment, then bank must keep that particular account as NPA. No need to upgrade it. This avoid any false hope and ensure that bank don't get caught up in the temporary recovery. Now there is something called proof of regularization. Show me the evidence. That is called the proof of regularization. Show me the evidence. That before an NPA can be upgraded, bank must prove to their auditor and inspector that the account is genuinely performing, not just on paper. Bank needs solid evidence to eliminate any doubt about the account status. It's not just enough to say, hey, we have made a few payment. The evidence must be clear and undeniable. So what we have learned, to sum it up, upgrade an NPA account after only proving satisfactory performance, like a probation period, right? You have a probation period, you must join with bank and you should have a probation period. Your performance was satisfactory, then only you were regularized. Second point, monitoring period lasts at least 1 year from the first repayment. From the first repayment, monitoring period will last at least 1 year, right? Third point, regularization require careful proof, especially around the balance sheet date. Inherent weakness must be considered. If the account shows sign of weakness, it stays as NPA, and bank need evidence to show that account is genuinely performing. So what is the one question for you? What do you think happened if the loan failed to upgrade after a year of monitoring? Let's talk about it in the next slide. So suppose that we have monitored the loan for a particular year and still the loan has failed to upgrade. What will happen? Let's talk about it now. So friends, ever wondered how the bank keep track of loan when a borrower has multiple facility or account? That is what we are going to discuss, right? Suppose a borrower has multiple facility, multiple account. How do bank keep track of them? And what about those derivative contract? You have heard about this derivative contract. What about those derivative contract? Can they become non-performing too? Can those derivative contract can also be called non-performing? So let's dive into the world of borrower-wide asset classification and derivative treatment. It is simpler than you think. So stick with me, and because we are breaking it all down. So the first thing is that unified treatment of borrower facility. So this is the point which we are going to discuss. Unified treatment of borrower facility, very very important point. Try to understand. Imagine a borrower who has multiple loan, multiple facility with the bank, like a loan for a car, another for working capital, and maybe even a guarantee. So suppose a borrower has three type of loan. He has taken car loan, he has loan for working capital, and he also has taken a guarantee from the bank. Right. So what happen if one loan go bad and become irregular? Suppose one loan go bad and become irregular, what will happen? Will all of a sudden the entire borrower profile can be marked as NPA, right? The entire borrower will be treated as NPA. Its profile will be treated as NPA, not just the facility that went bad, right? It is not just that the facility that went bad, the entire loan will be classified as NPA, right? All of a sudden. So it's like a student who has multiple subject. If they fail in one, the entire semester is at risk, isn't it? A student who has failed in a particular subject, so the entire semester is at risk. In simple terms, if any facility or any investment goes into NPA category, all facility for that borrower are treated the same way. This is done for better tracking and better management for the bank, by the bank. Is it clear now? Now let's talk about the next point that we have. That is called unified treatment. That is what we call debit from devolved letter of credit and guarantee. Let's talk about this point, what it means. See, not now what about the situation where there is letter of credit or guarantee involved. Suppose let's talk about a situation where LC is involved or guarantee is involved, right? So for example, let's say the bank has given a guarantee or a letter of credit to a borrower for a specific transaction. Even if these are in separate account, they will still be treated as a part of borrower main account. If the borrower failed to make the payment, it is treated like other account in the terms of asset classification. Again I am repeating that what will happen. Let's say the bank has given a guarantee or a letter of credit to a borrower for a specific transaction. Even if these are in separate account, they will be treated as part of the borrower main account. If the borrower failed to make the payment, if it is treated like other account in terms of asset classification. In simple word, so here we are talking about this point. Just wait a minute. So here we are talking about this point, debit from yeah, here it is. So in simple word we can say it does not matter where the money is, it's all count together when it comes to classifying whether the account is NPA or not, right? Now let's talk about bill discounted under LC, right? Let's talk about this point, that is bill discounted under LC. So what about it? What are the criteria for it is to come in under NPA? So here is a tricky one. Bill discounted under LC. So imagine the bank has discounted a bill under letter of credit, but the borrower's other loan are going bad. Does that mean the discounting bill are also automatically in NPA? Here is the catch. If the bank has not been paid for the bill and the borrower failed to repay for those bill, it will be only be classified as NPA, when the other loan or facility become NPA, right? It is like waiting for that final domino to fail. So don't worry, just because one loan goes bad does not mean that every bill the bank discounted turns into NPA right away, right? So again I am repeating that if the bank has not been paid for the bill and the borrower failed to repay for those bill, then it will only be classified as NPA, while the other loan or facility become NPA, right? So that is the point. So that is what written, that bill discounted under a letter of credit may not be classified as NPA when other facility to the borrower classified NPA. That is the point. You have to remember it, right? So this is facility wise. It's not borrower wise. Understood? Bill discounted under LC is just like a facility wise. However, if the document under LC are not accepted or payment is not made by the issuing bank, the borrower failed to repay, then it will be classified as NPA. Now let's talk about overdue receivable and derivative treatment. Let's not talk about the derivative contract, right? So bank holds some derivative contract which can also become a non-performing asset, right? So if the derivative contract has positive mark to market value, so here is the key point you must remember, that if the derivative contract has positive mark to market value, right, but remain unpaid for 90 days, then it will be classified as NPA. Essentially, if the bank is expecting money to come in but it does not, it will be flagged as NPA, isn't it? So positive mark to market value of a derivative contract, it is NPA if unpaid for 90 days or more. What about the forward contract and swaps? Let's talk about the about plain vanilla swap. So remember 90 days criteria is everywhere. If it is positive mark to market value of the derivative contract for 90 days, then it become an NPA. And if you talk about the forward contract and swap, you must remember that if these loan become NPA, it means all the funded loan for the same borrower are flagged as NPA borrower wise. Very very important. where borrower wise is super important. Sometimes it is facility wise, sometimes it is borrower wise, right? So what we come to know, that if these become NPA, like forward contract become NPA, swaps become NPA, then all the funded loan for the same borrower are flagged as NPA. It's like domino effect. You know domino effect, that you can't just isolate one loan, it impacts the entire borrowing credit standing. Remember it, super important. Understood? Now let's talk about the foreign exchange derivative from April 2007 to June 2008. Let's talk about it. So for those of you dealing with foreign exchange derivative, here is an interesting detail, right? So I think we have covered it already. Let me again rephrase it, that when this contract, we are talking about what? Exchange derivative, clearly written exchange derivative here. I am highlighting it. Clearly written that when this contract have a positive mark to market value, they need to be set aside in a separate account. But here is the twist. The twist is that if they got overdue for 90 days, they become NPA. So for those account, for this exchange derivative which has a positive mark to market value, they need to be registered. They need to be set aside in a separate account. Clearly written. They need to be parked in a separate account. And second point is that if they go overdue for 90 days, they become NPA. They will classified as NPA, right? So, but importantly, this won't automatically make all of the borrower loan NPA. Raz, remember it. For derivative, this is facility wise. This is not borrower wise. Understood? And for forward contract and swaps, this is borrower wise. So, if this particular derivative become NPA, it does not mean that all the loan which is taken by borrower will become NPA, right? So, remember the overdue amount. So it's like separating your personal finance from your business finance. The overdue amount in foreign exchange contract get marked as NPA, but other facility for the borrower are not automatically impacted unless they are also overdue. Understood? So suppose this borrower has taken car loan, this foreign exchange derivative loan, and also borrower has taken a guarantee. So if this particular derivative become NPA, if this derivative remain unpaid for 90 days, if it is overdue amount for 90 days, obviously it become NPA. But it does not mean that that particular car loan will also become NPA. Understood? Now let's talk about the next point, which is regarding the reversal of unrealized income. Very, very important. Here we are. Yeah, reversal of unrealized income. What it means? See, now let's talk about reversing unrealized income. What happens if the borrower has not paid back on time? So the question is, this borrower has not paid back on time. So this borrower has not paid back on time. What will happen then? You know that after 90 days of overdue payment, any income that was recorded on paper will move to a suspense account. After 90 day overdue, any income, suppose I have recorded some income on the paper, right? It will automatically be moved to the suspense account. Understood? Basically, any expected income that was not actually received is written off temporarily until the borrower actually pays up, right? Any expected income that was not actually received is written off temporarily. So let me write it down. Written off temporarily. We expected you to pay, but we won't count it until we actually see the cash. That is like saying, right? I expected that you will pay, but we won't count it cash until we actually see the cash. And right, understood? It is what we are talking about. So what I am talking, that what will happen if the borrower has not paid back on time after 90 days of overdue payment, any income that was recorded on paper will be moved to the suspense account. Understood? So to summarize the point is that borrower wise classification means, so let me summarize what we have learned just now. First of all, we have talked about that borrower wise classification. It means that if one facility become NPA, all facility for that borrower will follow. If any facility become NPA, all facility for that borrower will follow. That is called borrower wise classification. First point. Second point, we have seen that even guarantee and letter of credit linked to the borrower main account, right, for NPA classification. That is called borrower wise classification. If any account, if one facility become NPA, all facility for that borrower will follow. Bill under LC are only classified as NPA once the other facility go bad. Very, very important. That is why I have highlighted this point. That suppose there is a bill under LC, bill under letter of credit, this will become NPA only when other facility will become NPA. That is what I have told you, right? So clearly written, bill under LC are only classified as NPA once the other facility go bad, and derivative contract can become NPA if overdue for 90 days or more. And any reversal of unrealized income means bank write off uncollected due to suspense account. To where? Suspense account. So how do you think derivative contract can impact a borrower overall financial standing? I think we have covered it just now. Derivative contract we have covered it. So now let's talk about more about it. Additional consideration for derivative contract NPA. So friends, let's talk about it. So it's time to break down some serious derivative jargon into something simple. So ever heard of MTM value, suspense account, crystallized receivable? No worry, I am here to explain all of this, and by the end of this slide you will get this concept like a pro. Let's start with the MTM value component. Let's talk about this MTM value component. You know what the heck is this MTM? In simple terms, MTM stands for mark to market. It is a process where you adjust the value of an asset. What you do? So where you adjust the value of an asset, right, or a derivative contract. In this particular case, what is our asset? Asset is a derivative contract. You adjust the value of derivative contract based on current market condition, based on market condition. So when I say MTM, it means mark to market. It means it is a process where you adjust the value of a derivative contract based on the current market condition. So when we talk about MTM value component, we are talking about two things. So what we are doing, MTM value means what we are doing, that we are adjusting the value of an asset. What we have just discussed is regarding the MTM value, which is mark to market. It is a process where you adjust the value of an asset based on the current market condition. So when we talk about MTM value components, so here we are talking about what? Just wait a minute. So we are talking about MTM value components. You can see clearly written here. So it means that we are talking about two things. The first thing is that crystallized receivable, which means the money that has already owed and recognized. So this is the money which we have already owed, right? Let me write it down. This is the money which we have already owed and recognized, right? Is it clear? And the second part is positive or negative MTM, right, for future receivable. So these are the amount we expect to receive based on the market value but not yet received. So these are the amount we expect to receive based on the market value. These are the amount we expect to receive based on market value but not yet received. In simple terms, we can say that it is like checking if your future payment are still worth the same as when you made the deal. If the value changes, the MTM will reflect that change. So MTM has two components. Crystallized receivable means clearly means the money that has already owed and recognized, and positive or negative MTM for future receivable. This is the second component of MTM. It means the amount we expect to receive based on the market value but not yet received. So it is like checking whether if your future payment are still the same worth, are still worth the same as when you made the deal. You made the deal somewhere in the past, and if the future payment are the same worth as you made the deal, if the value changes, the MTM will reflect that change. And there is something called non-terminated contract. Here you can see non-terminated contract. Now let's imagine you have made a deal, but 90 days have passed and you still have not received the payment. What will happen? Well, the positive MTM, which means the amount you expected to receive that was earlier booked in your profit and loss account, get reversed, and it is transferred to a special account which we call as suspense account, positive MTM. So what is MTM? We have just talked about, where we adjust the value of asset based on the current market condition. That is called MTM. And you expected that you will receive such certain amount which you make the deal, right? But you have not received it for 90 days, right? So what will happen? That positive MTM will be reversed. Means you have already booked in your profit and loss account, but it will get transferred to a special account which we call as suspense account. Think of it as a saying, okay, we expected this money, but since you did not pay, we will hold it aside for now until we figure things out. This is like putting an unpaid bill in drawer until it is cleared up. Now let's talk about the subsequent changes in MTM. What are the subsequent changes in MTM? Let's talk about it. So friends, now once the MTM is in suspense account, what will happen if the market changes again? So suspense, this suspense is in MTM is in suspense account. Because that it has not been received, receivable is unpaid for 90 days. So this suspense is in under MTM is in suspense account. So your mark to market is in suspense account. Now the question is, what will happen if the market changes again? Well, if there is a positive change, we will credit it to the same account, that is suspense account, positive MTM. Is it clear? If there is a positive change to it, means you receive the payment, it will change to the suspense account, positive MTM, right? And sound easy, right? But what if the change is negative? Suppose the MTM decrease. So what is meaning of positive MTM? It means market value increase. Then it will be in the same account. But if there is a negative change, that means suppose the market value of your contract drop, we need to adjust it. and if there is not enough in the suspense account, we have to debit the remaining loss straight to your profit and loss account. So suppose the negative change is so much that nothing is left in your suspense account, then you have to debit your profit and loss account. It's like when your investment lose value, you either need to make up for it from the account, or accept the loss and move on, isn't it? So that is what is happening here. So understand it step by step. So what had happened, that earlier I expected payment to receive after a certain day, but not receive it. We just move it to the suspense account, that is positive MTM. But two things can happen: either the MTM is positive or the MTM is negative. If the MTM is positive, it means it will be credited to your suspense account, it will remain in the suspense account. But if the MTM is negative, suppose your value of your investment drop, then what you have to do? Then either you should debit the you should adjust the negative change to this suspense account, and if the account balance is insufficient, then you have to debit your profit and loss account. You have to assume that you have loss, right? You have made the loss. I hope this make your concept clear. So that is what we have learned. Now there is the subsequent changes in MTM. Now let's talk about the payment of overdue receivable. So what happened when the borrower finally pay the overdue receivable? Now suppose whatever the due it has been paid by the borrower, what will happen? So simple, we transfer the amount from suspense account, that is crystallized receivable, directly to the profit and loss account, right? We just transfer the whatever amount was in the suspense account, we just transfer it to the profit and loss account. This is like getting your late payment and finally recognize it as annual income in a book. So that is what will happen after the payment of the overdue receivable. Now let's talk about the other derivative exposure. What is the meaning of other derivative exposure? So friends, this does not stop with just one derivative contract. If you are dealing with multiple derivative, once one contract get classified as NPA, you handle the MTM for rest of them the same way. It is like dominoes, once one fail, the rest follow the same rule. Understood? Suppose you have taken multiple derivative contract, right? And once one contract get classified as NPA, you handle the MTM for the rest of them. So for derivative you have to handle the MTM like that, right? So treat all the other derivative contracts similar once one get classified as NPA. Simple, right? So let's lastly talk about the fund based credit facility. So you know that if you have got any fund based credit facility, which means the bank has actually lent out money and the loan get classified as NPA, then the MTM of all derivative exposure linked to that loan also need to follow the same treatment. So what I am saying you, that suppose you have got any fund based credit facility. What is the meaning of this fund based credit facility? When I say fund based credit facility, it means bank had actually lent out money. It means bank has actually lent out money, right? This is called fund based facility, right? And that particular fund based facility get classified as NPA. So what will happen? MTM of all the derivative exposure linked to that loan also need to follow the same treatment. It is a full system. If one loan goes bad, all the connected derivative are treated the same way. So to wrap it up, what we have learned till now is that MTM, that is mark to market value, it includes crystallized receivable, means money on, and the market change for the future receivable, right? Two things it includes. When a contract is not paid for 90 days, the positive MTM get moved to a suspense account. And suppose MTM change, so if there is a positive change, it moves to the suspense account. If there is a negative change, the losses get debited to the profit and loss account. If there is a payment received, suppose you receive the payment, then they are transferred back to the profit and loss account. And once one derivative is marked as NPA, all other connected follow the same rule. And finally, fund based credit facility impact how derivative are treated too. So do you think the way derivative are classified as NPA makes it easier for bank to manage risk? Do you think that the way we classified as derivative as NPA, it makes it easier for bank to manage risk? Drop your thought. Now let's move to the advanced under consortium management. Let's talk about it. So I think you know about the consortium management, right? What is the meaning of consortium management?